Here are the three biggest risks to retirement. All right, let's write these down. Number one, we have market risk, meaning it can greatly reduce your future income. Number two, we have legislative risks. Have you heard of that one before? Legislative risk is Congress can change the rules at any time. And then number three, we have tax risk. Rising taxes can decimate your retirement savings. And let's not forget about RMDs. Remember, RMDs require minimal distributions, or I like to say paying taxes forever. Here are the six biggest concerns and fears of why people attend. First of all, we want to pay less taxes. We want more predictable income. We don't want to run out of money. We want to be sure that our spouse is okay if we become or sick, injured, or die prematurely. And how do I reduce my market risk? And how do I pay for the cost of long term care? If you have a 401k, IRA, or utilizing a similar tax deferred strategy, odds are you're going to be paying a lot in taxes because if you're using any of these methods, it's costing you way more in taxes than you know. This alone, it's depriving most people from 30 to 40% of their hard earned retirement income. So, in the next hour, I'm going to tell you exactly what to do to set up what the industry calls a tax free retirement account. Now, a lot of people are never exposed to the tax free side of finance, and some don't believe it even exists, but I'm here to tell you that it absolutely does. It's called a TFRA or a tax free retirement account. And if it's set up properly, the money you save into it, the interest that's earned from it, and then most importantly, the money you take out of it is completely 100% tax free. And you know what? This strategy is not even a new strategy. It's been around for decades, and it's an updated version that the wealthy elites have been utilizing for a very long time to build tax-free wealth for generations to come. And if it's set up properly, which I'm going to show you how to do, will put you in the same boat as these families that have been doing this for decades, and it's 100% compliant with the current tax code. And it's not a loophole. Simply put, if you or let's say your advisor have been focused on only tax deferred strategies, it's very likely that you wouldn't have never been exposed to tax free vehicles, other options. So, under the IRS tax code, you are not required to report income from this account as earnings. So, essentially, any earnings or distributions from this account are not taxable. So, again, meaning they're tax free. And the reality is, most people don't even know how to actually set it up or who to even talk to that specializes in this to help them. Because most people use what's called a tax deferred account, like 401ks, 403bs, 457s, and IRAs. And with these types of vehicles, number one, you're responsible to pay a ridiculous amount of tax. Secondly, there are heavy restrictions and penalties to even touch your money. And then number three, you have nothing in place protecting your principal from market volatility, meaning you're going to definitely lose your hard earned money when the market dips or crashes. So, how can you rely on something that was really never created for retirement to begin with? On the flip side, with a tax free retirement account, first off, you're exempt from having to pay tax to the IRS ever. Number two is you have principal protection that removes you from market risk and volatility. You don't ever lose any money, your hard-earned money. And then number three, and we'll talk about a strategy how that's possible. It's called indexing, and we'll get into that later on. And then number three, you have liquid access to your money without any restrictions or penalties to do so. Is this making sense so far? Any thoughts? Any questions? Type them in the comments. All right. So go on to the next lesson, and we're going to talk about the 6 fundamental risks in financial planning. All right. Thank you so much.